The massive sell-off that we saw this earlier this week, allowing some of that frothiness that's driven the market gains this year to subside. So is now the time for investors to buy into tech at more attractive prices, or does it make sense to stay on the sidelines? We want to bring in Luke Bars. He is the managing director in fundamental equity at Goldman Sachs Asset Management. Luke, it's great to see. So I think so many people are trying to figure out what they should be doing, what the approach should be when it comes to tech right now. Do you think it's more attractively valued, or how should investors be buying in at these prices?
I think our starting point is selectively. There's great opportunity across the broad market, but specifically in tech as well. There are some transformational themes that are coming through that are driving earnings. There's no doubt there was a bit of froth in the market. And what we've seen in the last week or so is a correction that is, I think in many cases, quite healthy. But if we're finding where those fundamentals are still resilient and we're looking at how the market has traded in the last couple of days, it's really coming back to where can I find that earnings growth? Where can I find that cash flow generation and profitability? And I think for us now, there are some select opportunities that we think are quite appealing.
Luke, we were just talking about how you can't be looking at all of the tech names as a monolith. And I know that you in particular are trimming your exposure to hyperscalers. Talk to me about what long-term narrative that call is based on.
Yeah, so I think your first comment is critically important. I think we've just looked at technology and assumed everything is homogenous when actually there's huge underlying trends and themes that we need to decompose. And so for us, the Gen AI trend is a very transformational one that has been rewarding to some of the enabling technologies in the course of the last 18 to 24 months. And you've seen that crystallize into significantly higher earnings expectations and outcomes. What we're seeing now is a little bit of an adaptation in hyperscaler CapEx trajectory. And so we still see a lot of investment coming from those hyperscalers into chips and into the AI trend, but it's just being a little bit more thoughtfully delivered than it may have been over the last 12 months. And so where we're trying to be selective is if we haven't seen that pullback in valuation, if we're not seeing necessarily the normalization of that CapEx cycle that we think is healthy, we just need to be a little bit more cautious, but still selectively trying to find exposure that we think can deliver good upside on a forward 12 to 24-month basis.
Luke, when you take a look at the volatility that's played out more broadly speaking here this week, but it's been very noticeable even within the Mag 7 names, and specifically NVIDIA, it seems like every other day it's either down 7% or up 7%. What does that then tell us maybe about the expected volatility that we could see as the market remains so dependent on some of those uncertain factors, and a lot of that surrounding the econ data prints and what exactly that tells us about the Fed?
Yeah, so I think there's two critical parts to this. One is just the market had to absorb some negative macroeconomic data points that changed the direction of travel, or at least the pace of travel for the Fed. And so that was a bit of a whipsaw effect. But once the market recognized that actually we're on a cycle where the Fed is going to be normalizing rates, it might be a little bit quicker in the next 3 or 4 months than maybe was expected 10 days ago. But that cycle should be favorable in terms of just maintaining growth at a relatively stable level and helping to positively influence earnings over the coming year. Now, I think what is important within that, as we look at it more broadly, is saying, okay, well, what else is important within this that the market is focusing on? And when we come to technology, what is very apparent is not just the macroeconomic picture, but also the fact that people want to see, and I think Josh mentioned this a second ago, evidence that that Gen AI trade is actually driving positive outcomes. And where the market has struggled a little bit in the last month or two is show me in the software space where you have clear proof statement that this is additive. And so show me where you're putting that capital investment to work, that I can deliver a positive earnings outcome. And that is a little bit more difficult at this point because we just don't know how to utilize and apply some of those new techniques and capabilities in those software products to enhance that solution.
Luke, what do you look at to suss out the answer to that question?
Look, I think it's a very, very difficult question to answer. And I think the simple statement would just be we have to just be cautious and let it play out over the next year or two, because it's very hard to say with certainty this specific business has a solution, this specific business doesn't. But you'll get more evidence as we go through. I think our starting point is those businesses with very large market share will likely be able to maintain that market share as long as they stay up with the pack on some of those Gen AI capabilities. And so the question then is, how much are they having to spend and invest, and how attritional is that to margins and earnings? And to the extent that they can do that in a balanced fashion, actually those major software businesses still look fairly attractive.
Luke, we've talked a lot about tech. I'd be remiss to not get into your small caps call with you. You talk about you have some bullish sentiment on small caps, it seems. Does your view on small caps require a certain amount of speed from the Federal Reserve in terms of rate cuts?
Well, it's predicated on the view that the US economy is still fairly robust. yes, we will see a little bit of a normalization in growth. We saw this 2.8% annualized growth trajectory, and that will come down a little bit. But our current activity indicators still say troughing out at 1 to 1.5%. So this is still a soft landing scenario. And so the Fed dynamic is going to be one where there's a little bit of extra flexibility the Fed has if that growth cycle comes down a little bit more significantly. But we think the underlying trajectory for small caps, which is tied into the US domestic economy, is driven very favorably by what will be a rate normalization cycle. And now, whether that's 50, 75, or 100 basis points over the next 3 or 4 months, I think is going to be data driven for the Fed. But we know the trajectory we're likely on. And what I would say is for small caps specifically, you have a very clear history that from that point of peak rate, following that first rate cut, the next 12 months, you typically see 10 to 15% outperformance of small cap versus large cap. In principle, because one, you are seeing that positive impulse of monetary policy, but also because these are businesses that are tied to floating rate debt. And so that normalization of rates is very healthy in terms of margin and healthy in terms of passing through into superior earnings.
All right, Luke Bars, he is the Fundamental Equity Managing Director at Goldman Sachs Asset Management. Luke, thanks so much for taking the time to join us.
Thanks, guys.